Yield is one of the most important concepts in fixed income portfolio management because over the long run, yield accounts for the vast majority of returns in the bond market. But we need to recognize that a higher yield usually brings higher risk. Our portfolio construction process is designed to deliver what we think is the best combination of risk and yield through the credit cycle. Big picture, our expectation is that accommodative monetary policy by the Federal Reserve and global central banks should allow the U.S. and global economies to avoid a recession, but growth is expected to be slow. So we're looking for about 1.5% to 2% GDP growth in the U.S. And we think that geopolitical risk will remain high, particularly around trade policy. When we're looking at cycles and trying to identify risks, we often say, follow the debt and you'll probably find the next problem. So we're always on the alert for sectors that have been increasing debt faster than trend or faster than growth in the economy overall. In the last cycle leading up to the global financial crisis, we saw a surge in debt in the consumer and financial sectors, mostly related to housing. In this cycle, it's changed. Consumers have been repairing their balance sheet. The same cannot be said for the corporate sector, where debt has increased significantly, particularly in the investment grade sector. Investment grade corporate debt has risen by 2.5 times during this recovery, versus only 1.5 times for GDP growth overall. We believe that active management can make a difference as we transition through the phases of the credit cycle. We've seen growing interest in passive bond market indexes, and we think there's some real drawbacks to these. Because these indexes are typically market weighted, by definition, the sectors that have increased the debt the most will have the biggest weighting in those indexes. We think these may be the sectors that you want to avoid as we transition into the downturn. Given our outlook, we think it's prudent to be cautious but not overly defensive. It's too early to run for the hills. We still think that allocations to bank loans and high yield make sense, but we are being selective in moving up in quality. We also believe that inflation risk is being mispriced in the market right now. Inflation remains below the Fed's target of 2%, and the Fed is working to get inflation higher. So we're expressing this view in an overweight to Treasury inflation protected securities, or TIPS, which we think offer good relative value in this point in the cycle. That said, valuations appear to be stretched in certain corners of the risk markets. And there are plenty of risks out there right now. There's uncertainty about the pace of global growth, Federal Reserve policy, trade policy, and the upcoming 2020 elections. We think all of these have the potential to create volatility and opportunity going forward. We think it pays to be active and flexible, and we're maintaining portfolio liquidity at the higher end of our range in order to take advantage of any potential opportunities for the long-term benefit of our shareholders.